welcome to the deep dive. Today, we're going behind the scenes of the financial world,
right?
Exploring the alphabet soup of SEC regulations, GAAP, and IFRS.
Yeah.
These might just sound like intimidating acronyms, but trust me.
Okay.
Understanding these frameworks is like having X-ray vision for a company's financial health.
Exactly.
Yeah.
And whether you're an investor
Yeah.
trying to make sense of a company's reports,
Okay.
an employee wondering about your company's stability,
Mm-hmm.
or just someone who wants to understand the business world better,
Right.
this deep dive will equip you with the essentials.
So you might be thinking,
Yeah.
isn't this going to be a snooze fest?
Sure.
But here's where it gets interesting.
Okay.
One of these frameworks, IFRS,
Yeah.
is more like a set of guidelines,
Right.
while GAAP is much stricter.
Huh.
And guess what?
Okay.
That difference can significantly impact a company's financial picture.
It's a bit like comparing a jazz improvisation to a classical symphony.
Interesting.
Both can be beautiful and expressive, but the rules of engagement are very different.
Okay, let's start by decoding the SEC.
Okay.
I always imagine them as the financial world's version of those hawk-eyed referees in a sporting event, making sure everyone's playing fair.
That's a good analogy.
Yeah.
The SEC's primary role is to be the watchdog for the stock market, enforcing a whole slew of securities laws
Okay.
designed to prevent things like insider trading
Right.
or companies cooking the books.
So is it safe to say that the SEC is all about keeping things transparent and honest?
Well, transparency is a huge part of their mission.
Okay.
Think about it.
Yeah.
If companies could just hide or fudge their numbers,
Mm-hmm.
investors wouldn't have a clue what they were really buying.
Right.
The SEC makes sure companies regularly disclose their financial information,
Okay.
so everyone has a fair shot at understanding their performance.
But isn't there a concern that too much regulation could stifle companies and make it harder for them to innovate and grow?
That's a very valid point.
Okay.
It's a balancing act.
Yeah.
The SEC's job is to protect investors and maintain market integrity,
Right.
but they also need to be mindful of not stifling economic growth.
Okay.
It's an ongoing debate
Yeah.
about where that line should be drawn.
Okay. So the SEC is the referee.
Yeah,
But what about those two major acts they enforce?
right.
SOX and Dodd-Frank.
Think of SOX,
Okay.
the Sarbanes-Oxley Act, as the heavy hitter that stepped onto the field.
Okay.
After those infamous accounting scandals of the early 2000s,
Yeah.
like Enron.
So SOX was like a much-needed reality check for corporate America.
Exactly. It tightened the screws on financial reporting, demanding much stricter internal controls
Okay.
and making executives personally liable
Wow.
for their company's financial statements. Suddenly, CEOs and CFOs couldn't just plead ignorance
Right.
if their company was playing fast and loose with the numbers.
And Dodd-Frank,
Yeah,
that came after the 2008 financial crisis, right?
correct.
Oh.
Dodd-Frank was like bringing in a whole new set of rules to the game,
Okay.
aiming to prevent another financial meltdown.
Yeah.
It focused on areas like regulating complex financial instruments,
Okay.
increasing transparency in the derivatives market, and creating the Consumer Financial Protection Bureau
Right.
to safeguard consumers from predatory lending practices.
So both of these acts, in their own way,
Yeah.
were responses to major crises, highlighting the importance of having a solid regulatory framework in place.
Absolutely.
Okay.
And they illustrate how the financial world is constantly evolving, with regulations adapting to new challenges and risks.
Now, let's move on to the accounting rule books themselves.
Okay.
First up, GAAP,
Yeah.
the Generally Accepted Accounting Principles. It sounds very official.
It is.
Okay.
GAAP is the gold standard for accounting in the U.S.
Right.
The rule book that companies must follow
Yeah.
when preparing their financial statements.
Okay.
Think of it as ensuring that everyone's speaking the same language
Mm-hmm.
when it comes to financial reporting.
So GAAP is all about creating a level playing field
Exactly.
for investors
Uh-huh.
by making financial reports clear,
Mm-hmm.
consistent,
Yep.
and transparent.
GAAP aims to ensure that you can compare apples to apples
Okay.
when looking at the financials of different companies.
Yeah.
For example,
Okay.
if two companies both report a $1 million profit,
All right.
you want to be sure that they've arrived at that number
Mm-hmm.
using the same accounting methods. Otherwise, that $1 million profit could mean very different things.
Right. That makes sense.
Mom.
But how does GAAP actually work?
Wow.
What are some of the key principles behind it?
One of the cornerstones of GAAP is the principle of conservatism. That means companies shouldn't overstate their assets or understate their liabilities.
Right.
They should err on the side of caution
Okay.
when reporting their financials.
But wouldn't that make a company's financial picture look less attractive to investors?
It might in the short term.
Okay.
But remember,
Yeah.
GAAP is all about providing a realistic and reliable picture
Okay.
of a company's financial health, even if it means being a little less rosy.
So it's about building trust in the long run,
Yeah,
even if it means sacrificing some short-term gains.
precisely.
Okay.
Another key principle is the matching principle.
Right.
This means matching expenses with the revenues they generate. For example,
Right.
if a company sells a product in December
Okay.
but doesn't get paid until January,
Right.
they should record the revenue and the associated expenses
Okay.
in the same accounting period.
So it's about accurately reflecting the timing
Exactly.
of when revenue is earned. Yep. And expenses are incurred.
And this helps to provide a more accurate picture
Okay.
of a company's profitability over time.
GAAP seems to cover just about everything when it comes to accounting.
Oh,
Are there any specific areas within GAAP
definitely.
that often cause confusion or debate?
Revenue recognition,
Okay.
for example,
Yeah.
is notoriously complex.
Right.
Imagine a company that sells software subscriptions.
Okay.
When can they actually say they've earned that revenue? When the customer signs up, when they make the first payment,
Okay.
or gradually over the life of the subscription.
Wow, that does sound tricky.
It is.
Yeah.
And there are different GAAP standards
Okay.
for different industries and types of transactions,
Okay.
which can make things even more complicated.
So understanding GAAP is about more than just knowing the basic principles.
Yeah,
It's about knowing how those principles are applied in specific situations.
you got it.
It's a deep dive in itself. Right. Okay, now let's hop on a plane and talk about IFRS.
Okay.
The International Financial Reporting Standards.
Yeah.
It's like JAP's cosmopolitan cousin, right?
You could say that
Wow.
IFRS aims to be the universal language of financial reporting,
Right.
used in over 140 countries.
So if a company wants to do business internationally,
Uh-huh.
they need to be fluent in IFRS.
Pretty much.
Oh, okay.
IFRS makes it easier for investors to compare companies from different parts of the world without getting lost in translation.
But if IFRS is so widespread,
Yeah.
why hasn't the U.S., a global economic powerhouse,
Yeah.
fully adopted it?
It's a good question.
Yeah.
And a topic of ongoing debate.
Okay.
Some argue that IFRS is a more modern and flexible system, better suited for a globalized economy.
Okay.
They point out that it's more principles-based,
Right.
allowing for more professional judgment,
Okay.
whereas GAAP, with its detailed rules,
Yeah.
can sometimes feel like trying to fit a square peg into a round hole.
Hold on. Isn't having clear rules a good thing? Wouldn't that prevent companies from playing fast and loose with their accounting?
That's the argument from the GAAP camp.
Okay.
They worry that IFRS's flexibility could open the door to inconsistencies
Right.
and make it harder to compare companies.
Yeah.
They also point out that switching to IFRS would be a massive undertaking for U.S. companies, requiring significant changes to their systems.
Yeah.
And potentially even restating past financial statements.
So it's a tug of war
Exactly.
between consistency and flexibility,
Huh.
with valid arguments on both sides.
And the debate continues as to whether the benefits of a single global standard
Right.
would outweigh the costs and complexities of the U.S. making the switch.
All this talk about rules and principles makes my head spin.
Yeah.
Can we break it down with a real-world example?
Absolutely.
Okay.
Let's take inventory valuation.
Right.
Imagine a company that sells gadgets.
Okay.
Under GAAP, they can use the LIFO method. Last in, first out, to calculate the cost of goods sold.
Right.
It assumes that the most recently purchased inventory is sold first.
So if gadget prices are rising,
Right.
LIFO would make it seem like the company is spending more on inventory
Yeah.
and making less profit.
Right.
Right.
And that can impact their tax liability. But IFRS doesn't allow LIFO.
Yeah.
It only permits FIFO,
Right.
first in, first out,
Right.
which assumes the oldest inventory is sold first. This can lead to different reported profits and
Yeah.
tax implications depending on which system is used.
That's a pretty clear illustration of how a seemingly technical difference
Yeah.
can have real financial consequences.
It highlights the importance of understanding the nuances of each system.
All right, one more example.
Okay.
How about intangible assets?
Oh, fine.
Those tricky things like patents or brand names.
Under IFRS, companies can capitalize certain development costs,
Okay.
adding them to the balance sheet as assets. If specific conditions are met,
Right.
this essentially lets them spread those costs over time,
Okay.
potentially making their profits look better in the short term. GAAP, however,
Yeah.
is stricter and generally requires these costs to be expensed immediately,
Right.
hitting profits right away.
So a company reporting under IFRS could potentially paint a rosier picture.
Potentially,
Oh,
yes.
oh.
But IFRS does have safeguards in place to prevent abuse.
Right.
It's a delicate balance between allowing companies to reflect the true value of their assets and preventing them from inflating their financial performance.
Oh, those talk about different accounting standards has made one thing crystal clear.
Right.
Context is king.
Couldn't agree more.
Yeah.
You can't just look at the numbers in isolation.
Right.
You need to understand the framework they're based on to make informed judgments.
Speaking of judgments,
Yeah.
we've talked about the rules,
Right.
but how do we know companies are actually following them? It's not like they're just on the honor system, right?
Of course not.
Okay.
That's where those financial inspectors we mentioned earlier, the external auditors, come in. These independent accounting firms come in to scrutinize a company's books, ensuring they're following the appropriate accounting standards, GAAP or IFRS,
Right.
and that their financial statements are accurate.
So they're like the financial detectives,
Exactly.
making sure no one's trying to pull a fast one.
They dig deep,
Okay.
checking if the numbers add up,
Yeah.
if the accounting methods are consistent, and if everything is above board.
And what if they find something fishy?
Then it's showtime for the regulators.
Oh.
The SEC or its counterparts in other countries step in to investigate.
Okay.
And if warranted, take action against companies that aren't complying.
Yeah.
We're talking fine sanctions,
Wow.
even criminal charges in some cases.
So there are real teeth behind these rules, not just empty threats.
And that's critical for maintaining investor confidence and preventing those market meltdowns we talked about earlier.
Okay, we've covered a lot of ground, from decoding acronyms to exploring the nuances of accounting standards.
Right.
But I think it's time to bring it back to our listeners and answer the big question. Why should they care about all of this?
That's the million-dollar question.
Yeah.
And the answer is that it affects everyone,
Go ahead.
not just investors or accountants.
Right.
Financial and regulatory compliance is the bedrock of a healthy economy.
Okay. Break that down for me.
Yeah.
How does it impact someone who's not a Wall Street whiz?
Think of it this way.
Okay.
When companies play by the rules and their financial reporting is transparent,
Yeah.
it encourages investment. People are more willing to put their money into companies they trust,
Right.
leading to economic growth, job creation, and a more stable financial system.
So it's like a ripple effect.
Yep.
Honest accounting practices ultimately benefit everyone.
Precisely.
Oh.
On the flip side,
Yeah.
when companies fudge their numbers or engage in shady financial practices,
Right.
it erodes trust,
Right.
not just in that company,
Yeah.
but in the entire system.
It's a domino effect.
Exactly.
Leading to uncertainty, market volatility, and potentially even another financial crisis.
So even if you never buy a single share of stock,
Okay.
financial and regulatory compliance impacts your life in countless ways.
Right.
It affects the stability of your job, the value of your retirement savings, and the overall health of the economy.
Now, we can't talk about the future of finance without addressing the elephant in the room.
Okay.
Technology, the financial world, is rapidly digitizing.
Yeah.
How is this impacting financial reporting and compliance?
Technology is a game changer,
Okay.
revolutionizing how companies manage their financial reporting and stay on the right side of the regulations. We've gone from those dusty old ledgers to sophisticated software that can automate tasks, analyze vast amounts of data, and generate reports in real time.
So less room for human error.
Absolutely.
And a faster, more efficient process.
But it goes beyond speed and efficiency.
Okay.
Technology empowers companies to identify potential risks and ensure they're following those ever-changing regulations.
Right.
Think of it as having a super-powered financial assistant working around the clock.
What are some of the specific technologies having the biggest impact?
Well, cloud computing is a major player. It allows companies to access their financial data from anywhere, anytime, making global operations much smoother.
Okay.
Artificial intelligence and machine learning are also shaking things up.
Yeah.
Automating tasks like data entry reconciliation, even detecting potential fraud.
So AI isn't replacing humans,
Exactly.
but it's giving them superpowers.
AI is like that tireless watchdog, sniffing out inconsistencies and anomalies that might escape even the most eagle-eyed human accountant.
And then there's blockchain.
Yeah.
It's technology behind cryptocurrencies.
That's the one everyone's buzzing about.
Yeah. How is it impacting financial reporting?
Blockchain has the potential to be truly disruptive.
Oh.
Imagine a system where every financial transaction is recorded on a secure, tamper-proof ledger, accessible to auditors in real time.
Okay.
That would make auditing more efficient, reduce the risk of fraud, and build a new level of trust into the system.
It sounds like a futuristic vision of a more transparent and accountable financial world.
It is. Yep. And while it's still early days,
yeah,
blockchain is definitely a technology to watch in the coming years.
It's fascinating how technology is reshaping this field. But let's not forget the human element.
Right.
We've talked about rules technology and watchful regulators, but ultimately it's people who make the decisions and ensure ethical conduct. What qualities are essential for success in this complex world of compliance?
You're absolutely right.
Okay.
Technology can be a powerful tool, but it's the people who wield it that truly matter.
Right.
So what does it take to thrive in the world of financial compliance?
Okay.
First and foremost, you need a rock-solid ethical compass.
Right.
Compliance professionals are the guardians of integrity.
Yeah.
They need to be unwavering in their commitment to doing what's right, even when it's tough.
So it's not just about knowing the rules.
Exactly.
It's about having the moral fiber to uphold them.
You also need to be a master of detail.
Okay.
With a deep understanding of accounting principles and the ever-changing regulatory landscape.
Right.
It's a field that demands both technical expertise and a willingness to constantly learn and adapt.
So it's not a job for those who are afraid of a challenge or get bored easily.
Not at all.
Okay.
And of course, communication skills are crucial. Compliance professionals need to be able to explain complex concepts clearly to a variety of audiences, from executives to auditors to regulators.
Right.
They're the bridge between the technical world of finance and the people who need to understand it.
So it's a blend of technical expertise, communication skills, and a strong moral compass.
It is.
Sounds like a demanding but potentially very rewarding career path.
And for those who are passionate about integrity and have a knack for numbers and regulations, it can be a fascinating and impactful way to make a difference.
We've talked about the foundations of financial reporting and the role of technology, but it feels like the financial world is in constant motion.
Yeah.
What are some of the big waves crashing on the shores of this industry?
One of the most powerful currents is the push for non-financial reporting.
Okay.
Investors and the public aren't just interested in profits anymore.
Right.
They want to know about a company's impact on the environment, society, and how well they're governed. We're talking about ESG, environmental, social, and governance factors.
So it's not just about the bottom line.
Right.
It's about the triple bottom line.
Exactly.
People, planet, and profit.
That's a great way to put it.
Yeah.
And this shift is driving a demand for standardized and transparent ESG reporting.
Are there any common rule books emerging for this kind of reporting? It seems like a pretty new area.
It is, but there are several initiatives gaining traction.
Okay.
The Sustainability Accounting Standards Board, or SASB, has developed industry-specific standards for ESG reporting, helping companies focus on the most material ESG factors for their sector.
Right.
And the Global Reporting Initiative, GRI,
okay,
offers a comprehensive framework for sustainability reporting, covering a wide range of ESG issues.
So companies are feeling the heat to disclose not just their financial performance, but their ethical and sustainability practices as well.
Absolutely. And this trend is only going to intensify.
Right.
Investors are increasingly using ESG factors to make investment decisions.
Yeah.
And consumers are more likely to support companies that align with their values.
But honestly, how can you measure something like a company's social impact? It seems pretty subjective.
That's one of the biggest challenges in ESG reporting.
Okay.
There's no universal yardstick.
Right.
And what counts as good ESG performance can vary, depending on the industry and the stakeholders involved.
So it's not as simple as just ticking boxes on a checklist.
Definitely not.
Okay.
Companies need to develop robust systems for collecting and verifying ESG data, ensuring accuracy and transparency.
Right.
And they need to go beyond simply reporting data.
Okay.
They need to tell a compelling story about their ESG journey,
Right.
demonstrating how they're integrating these considerations into their business strategy and operations.
It sounds like a lot of work.
Yeah.
Especially for companies that are already juggling complex financial reporting requirements.
Yeah, it is.
Right.
But leading companies see it as an opportunity, not a burden.
Right.
They understand that strong ESG performance can enhance their reputation,
Okay.
attract investors, and even mitigate risks.
So it's about moving beyond compliance.
Exactly.
And seeing ESG as a driver of long-term value creation.
And this is where strong leadership comes in.
Okay.
It takes commitment from the top to drive meaningful ESG integration and create a culture where sustainability is embedded in every aspect of the business.
Okay, let's shift gears to another major challenge facing the financial world.
Right.
Cybersecurity. With so much sensitive data flowing through digital channels, how are companies protecting themselves from those digital bandits?
Cybersecurity is the ultimate high-stakes game for financial institutions.
Right.
They're constantly under attack.
Okay.
And the consequences of a breach can be devastating.
Yeah.
So companies are investing heavily in building digital fortresses to protect their systems and data.
What are some of the key strategies they're using to keep the bad guys out?
It's all about creating layers of defense.
Okay.
Think firewalls, intrusion detection systems, and sophisticated encryption to scramble data and make it unreadable to unauthorized eyes.
Sounds like a digital arms race.
It is.
With companies constantly having to upgrade their defenses to stay ahead of the hackers.
And it's not just about technology. Companies are also focusing on the human element.
Right.
Because often the weakest link in the chain is a careless employee who clicks on a phishing email.
Right.
Or falls for a social engineering scam.
So they're investing in employee training programs.
Exactly.
To raise awareness about cyber threats and teaching best practices for staying safe online.
So it's about building a culture of security awareness.
Okay.
Where everyone understands the importance of protecting sensitive data.
And this brings us to another trend. The increasing role of regulators in cybersecurity. They're recognizing that cyber attacks aren't just a problem for individual companies.
Right.
They pose a systemic risk to the entire financial system. So if one bank gets hacked, it could have a ripple effect throughout the entire industry.
So regulators are stepping up, setting stricter cybersecurity standards, conducting more frequent audits, and even imposing hefty fines on companies that fail to meet those standards.
So it's a shared responsibility.
Absolutely.
Companies need to step up their game, and regulators need to provide the oversight and enforcement to ensure everyone is playing by the rules.
And it's not just a domestic issue.
Right.
Cyber attacks often cross borders.
Yeah.
So international cooperation is essential to combat these threats effectively.
It's a complex and constantly evolving challenge.
Yeah.
But it sounds like progress is being made.
It is.
Okay.
And it's a reminder that in today's interconnected world, cybersecurity is everyone's responsibility.
We've explored a lot today, from the fundamentals of financial reporting to the cutting-edge trends shaping the future of this industry.
Right.
It's clear that the world of finance is dynamic, complex, and filled with both challenges and opportunities.
It's a field that's constantly evolving, driven by factors like globalization, technological innovation, and changing societal expectations.
And as we've seen, it's a field that touches all of our lives.
Absolutely.
Whether we're investors, business owners, or just everyday consumers.
Understanding the forces at play in the financial world empowers us to make informed decisions, navigate the complexities of the market, and contribute to a more stable and sustainable economic future.
That's a perfect note to end on.
Yeah.
Thank you for joining us on this deep dive into the world of financial reporting and compliance.
Thanks for having me.
We hope you've gained some valuable insights and, who knows, maybe even sparked a newfound interest in this fascinating field. Until next time, stay curious.